Thanks, Katie. Good afternoon, everyone. And it's my pleasure to introduce our next speaker, Steve Duff, Omafra's Chief Economist. Coming from a dairy and beef background in Northumberland County, Steve completed a master's in ag economics from the University of Guelph in 1996. Steve joined Omafra in late 1997 after a year as a policy researcher with the Dairy Farmers of Ontario. For close to 15 years, Steve was Omafra's lead on business risk management programs such as agri-stability and crop insurance. Steve is currently Omafra's chief economist. Steve is an adjunct professor at the University of Guelph teaching fourth year agricultural economic policy. Steve and his wife Robin also operate a beef and cash crop operation near Coburn, Ontario. So welcome, Steve, and I am going to turn it over to you.
It's a real pleasure to be here and speaking to the conference. It's something that I look forward to every year, and it's a good opportunity to share information, and I welcome a chance to have some discussion about it. And following up after John's presentation, I think it is going to be quite good because I think there's a lot of things that overlap in terms of the information, and so we'll try to keep going. So what I want to try to do today is give you basically a situation and outlook of the North American and Ontario cattle and beef markets. We're a small price-taking country and pretty much everything except canola, really. And so, you know, we pretty much always have to look at the United States as the base for that. So we're going to spend a little bit of time on there. We're going to look at Ontario and Canada and some of the nuance and things going on there. Then we'll get into a bit of an outlook. So in terms of the US, you know, we have both, again, the pleasure and the challenge of living next to them, being integrated with them. You know, that the last 4 years has shown some of the challenges that can create. I think to some degree, COVID has also shown some of the benefits of that relationship in terms of food supplies and whatnot. And we'll cover that as we go. And I think that's something as Canadians we have to keep thinking about as time goes by in certain sectors, and beef and the livestock industry is one of them. The thing I think that's really, you know, changed about the US in the last number of years is the real focus on exports and the focus on basically increasing productivity and overall levels of production. You know, you could argue that, you know, year after year for a number of years now, the US is hitting record levels of production. Pretty much across the meat spectrum. And it's not just because their population's growing, they're trying to feed more of their own people. It's because their focus is on exports. And when we deal with the US, like we do with in dairy, for example, you know, their focus is exports, and it affects the way they approach the market, which means their primary focus is on productivity, which is good for us because we have an opportunity to participate in a lot of the gains from a research and a tech transfer point of view. And I think that's kind of one of the histories of North American agriculture in general. And that record production pushes them on certain tracks. And one of those is that it can add a lot of volatility within production years. And we're seeing that more and more, especially in grains. And we'll talk more about that. Pork and chicken production has risen over 50% since 2000 in the United States. Beef production has risen 1%. The focus on, from an export point of view, from the US's perspective, is pork. There is a significant push in that regard. Chicken production a little bit less so. Chicken is a highly integrated industry in ways that we don't really see here in this country through the value chain. But certainly beef in its cyclical nature, which we'll continue to talk about, has been reasonably flat. And there's a bunch of different reasons for that, tied to weather, crops, et cetera, that you're all quite aware of. Beef production was down in 2000, about 1%, and the USDA's outlook thus far, which they'll be coming out with a new one later in February, is expected for that to stay reasonably flat. Again, the US is constantly looking for export markets, and I think one of the things that, you know, when we, you know, John talked a lot about imports, there was also a fair bit of discussion about exports, and when industries get built into export markets, I think one of the challenges that comes with that is when there's volatility within those domestic markets. So with volatility within China, volatility within Japan, South Korea, et cetera. The US has seen a really big increase in exports to China over this last year. And the thing that's unique about China, and it's also to some degree one of the challenges we face as a country, a small country that is, in dealing with the United States, is that when they demand product it's in really large volumes. It's in significant volumes in ways that can have a big impact on a domestic market. If you look at hogs in Ontario, for example, we only need about 35 to 38% of the sows we have to feed Ontarians. The rest of it is exported. And if you channel that product into a specific market, and I think this goes to John's point about commodity agriculture in general, is that, you know, there's rewards to that, but there's also risks to that. And the US faces that significantly because they truly are, in aggregate, a commodity producer. And so, you know, it's been great for them from the perspective of having greater access to China over the last year, despite some of the geopolitical issues they have with China. But that can change quickly. And we see that in the negotiations, et cetera, that the US has got going on with China. And it's something to watch. And from our perspective, I think, you know, what you can see is they've had some growth in Japan, they've had some growth in South Korea, markets which we're well into, markets where we have free trade agreements, so we have less fettered access. We can access those markets in a more sustained way over time. So, you know, it's one of those things I think that in this example, we need to sort of watch and learn a little bit from the US experience. You know, from my perspective in dealing with the sector, and, you know, I've had the pleasure and I guess mispleasure of being involved in a number of things over an extended period of time. The events with COVID is really the first example in North American agriculture in my lifetime where we've had such a potential significant shutdown of some capacity of the industry. There really hasn't been too many other examples other than maybe the rapid sell-off of the cow herd in the US in 2012 with the drought that they went through. But rarely do you lose production capacity in a sector in world agriculture, but certainly in North American agriculture, in the ways that we had at times throughout this COVID event that we're, you know, a year into now. And one of the things that is reflected in is the US beef cutout. And that's basically the wholesale value of a beef carcass as measured to the US. And because it was so extreme this year, it was worth pointing out from my perspective. And so the US market basically, from a fed steer point of view, follows that. Now, the US fed steer market is a little bit different than the Canadian market because they have mandatory price reporting in the US, which has a different context in terms of the way the information is produced and available. And so it's a lot different. It's more like the auction prices that we would get here on stocker cattle, where the biggest volume go through the auctions. But the US fed price does very closely follow that beef cutout. And so if you look at over time, the average spread in the US between the fed steer price and that cutout is around $2.70. But in 2020, it averaged in the neighborhood of $57. And in May, which was the big time when the US market from a processing point of view really hit COVID in terms of production losses, slowdowns, closures, the cutout went up to all the way up to $406 a hundredweight. Well, fed steer prices rose, but they rose to 171. And so the interesting thing sort of to understand and examine is, you know, did these prices then flow through to the retail level? And that's not always the case. There's a lot of market power. There's a lot of inelastic demand in food. In other words, people don't necessarily change demand right away. And because they're substitutes, you can't always reflect that price flow through to the retail sector. But the US retail price did spike, not quite to the same level, but it did spike. And it's interesting and something that we observed and something we wanted to keep a close eye on. One of the challenges of the Canadian market, and there's a number of them from an information point of view, is that we don't have a measured beef or pork cutout value. Canfax worked with Ag Canada, and they're working on it right now to try to do some revisions to a model that we've had in the past. But we don't have a measurement of it in terms of the forecasted or the measured manufacturing value. The US this last year went through a situation where for a considerable period of time, there was expectation of record production. And again, when it comes to the grain side of things, that is something that, you know, the US does create, because they're a large price setting country, they do have what we refer to as a yield price offset. Production goes up, and as a result, they drive the market, and that can offset or soften prices. And so this past year going into basically November, and November is when the US does their first measurement of actual yields. All through the summer, if you're watching markets, et cetera, those are forecasted models effectively. And the models are pretty accurate. and the Chicago markets, et cetera, use them as a guide, but it's November that's the first time where you're getting on the ground measurement. And this chart would reflect that. And so there was an expectation that the crop year was at record or near record levels as far as yields are concerned and production. And that had a big impact on markets throughout the summer as we're sort of expecting that and as we went into the fall. There's been some changes in that, which I'm going to talk about, which had a pretty big impact on the market. And if you're following the Ontario market, you'll know that that's the case. The other aspect is looking forward is the crop conditions and the drought levels in the U.S. And again, the U.S. has significant amounts of analysis on their drought monitor. This is publicly available information. It's updated weekly, and it's really, really interesting stuff. And if you go back in time, this drought monitor has been a pretty good predictor of some of the challenges that the grain sector has faced, and that transmits into other sectors. And so really where we're at right now, and this is January 12th, it hasn't changed a whole lot since then. You've got about 36% or close to 40% of the main corn and soybean areas in the US are affected by drought and fairly significant levels of drought. You also have about 41% of the cattle areas. And the cattle areas can be divided into two things: hay producing areas and areas where the cattle are based or pastured. And the two aren't quite the same. But either way, I think the thing to remember about that is that this particular chart, this map, doesn't look a whole lot different than it did in 2012. In 2012 was coming at the, a couple years into the ethanol mandate in the U.S., and the drought that occurred at that time set us on a path for grain prices that were really high for an extended period of time. And at this point in time, in that crop year, or going into that crop year, you had a similar looking graph. So the next number of weeks, month or so, is going to be really important in terms of what it sets the stage for getting crops in and where that goes as far as grain prices are concerned. Again, the cattle cycle is one that has changed a little bit over time to some degree because of the significant change in grain prices that have happened in North America due to ethanol, due to the 2012 drought. But in general, we've kind of gotten back to a point where we are in a cycle when it comes to cattle. And the U.S. cow herd is reflecting that despite this sort of export focus. And I think that's one of the reasons why the beef production numbers in the U.S. haven't really continued to peak the way chicken and hogs have. The cycle in those industries are considerably shorter, obviously from a gestation point of view, but also because of the nature of how you can bring animals in or out of the marketplace to meet that demand. And so the U.S. cow herd bottomed in 2014, it peaked again in 2018, and now it's in its second year of slight contraction. And I say slight because it is relatively low. And so, it's not the historical. If you look back into 2008, if we were to go back into the 90s or in the 80s, where you have almost a fairly steep curve, I think it's more a reflection of, strong demand, but hesitancy from a supply point of view. And I'll come back to that in a minute. In terms of the U.S. beef supply disposition, again, I think that where the U.S. is faced is really one of the key drivers, I think, in the next little bit is going to be stocks and where their inventories carry forward. Production is reasonably flat, as we've seen, even though we're, arguably in a little bit of a downturn or contraction. They have basically this expansion of exports to China, which overall gave them a slight increase in exports. And so there is, from their perspective, growing demand internationally. Their domestic demand is flat to slightly growing in general in the U.S. Flattening or flat per capita demand is offset by a growing population, and in general, that's the sort of the adage for all food, really, not just meat. And so, in general, I think it's reflecting some sort of flatness as we look forward from the overall disposition point of view. The risk factors that play from here into the futures market, which play into daily and weekly prices that each of you would experience, really stems around, I think, production. Does the U.S. end up in a significant drought that either significantly affects the price of corn, which then affects the ability to feed cattle and the costs associated, or do we end up in a circumstance like the U.S. faced in 2012, where not only was it expensive to feed cattle, but basically people liquidated herds with the reason being that they didn't have that base pasture and grass base to feed them. That's not something that really ever happens in the context of Canada. We'll have, on occasion, prescribed drought regions across the country, but they're generally fairly rare and generally don't result in significant depop. So that's a really significant thing to watch, because depopulation on the cow herd side can be a long-term impact, as everybody on this call is well aware of. So where does that play into the Canadian situation? Again, we're a price taker. The US sets the market for us pretty much in every commodity, and that is all across the agri-food value chain. And there's benefits and there's risks associated with it. One of the benefits that you'll hear me talk about when I do these types of presentations is that we have access to information, because they set the market. So you have futures markets and the like, but there comes a challenge because you have to watch them as much as your own market and understand that. In the Canadian context, the Ontario context, meat demand continues to grow. To a large degree, this is because of population growth. And so you can say the same for the bulk of food commodities, really, which in and of itself is important, because it goes back to John's point about how you approach your market, how you approach wanting to differentiate, et cetera. I'm going to keep coming back to that. In the last 10 years, we've really only seen chicken in this country or this province be a growth industry from a per capita point of view. But per capita isn't really everything, because we're not dealing with the aggregate. This is what individuals do. And as populations change, as people age, those per capita changes a lot with it. But there are some significant trends, I think, that are important to consider, and the beef industry is within that and has opportunity to meet that demand and benefit from it. And that is that the demand for lean protein is rising. And that has been the case. And over the last 10 years, as an example, beef has seen about a 1.5% decline in per capita growth, but overall is flat due to rising population. And to John's point, within that, there is significant growth in terms of certain market attributes. And it's those attributes, I think, that can be taken advantage of by individual producers, or in certain respects, in terms of more branded product, we can hopefully add to the carcass value of an animal and in turn increase value back to producers. So as John mentioned, we talk a lot about exports, we talk a lot about meeting local demand, but beef imports are a significant part of the Canadian value chain, and a more important part in many respects of the Ontario value chain. And so we've seen, some fluctuation, obviously, in imports over time, a big dip in imports on a percentage basis as we went through the BSE years, a rebuilding of that. And then the last few years, we've seen a decline to the point where, we're sort of in the mid-range of those pre-BSE levels, and we're currently at about 19%. As John mentioned, we're importing about 35 to 40% of the total beef we consume here in Ontario. And that's an important point. And again, the how that beef is comprised, what it looks like, is a significant part of us trying to understand where we can meet those needs and where we can benefit, hopefully, in the long term as a beef industry. Our cow herd has declined at a national level since 2017. It's not been a significant decline. If you look back and see the sort of the peak that came in 2005 with BSE and the steepness of that curve after that period of time, we're kind of in a bit of a holding pattern, arguably, even though we're in a decline. Ontario has been unique in that, from a national context, we've really been the one that's risen slightly, and it is slight. It's only about 1% during that period. And I think that goes back to John's point about there being opportunity, excess demand here, which I'm going to talk more about, and an ability for us as an industry to fill some of that gap in a more differentiated way. And I think that's one of the things that's kept the cow herd in general here, despite all of the pressures that it faced. Forget about the price of beef or the price of calves or fed cattle, but the pressure on pasture, the pressure on substituting pasture and grazing and hayland for corn or soybeans, the fact that, we saw the Bruce Peninsula Calf Club on here earlier, which is an excellent example of the opportunity and the work that's there to improve the sector. But where that, some of those calf clubs is based, the ability to produce grain and oilseed commodities has changed significantly over the last 20 years. And all of those things put pressure on the land that we use and the alternatives that are available for producers. So looking at our fed cattle numbers, we've been dealing as an industry across Canada and within the Ontario market for a number of years with trying to understand the market in better ways. BSE brought it out, from my experience, quite a bit. We got a little complacent, I would suggest, for a number of years in terms of understanding information, and certainly COVID has brought that back. And one of the challenges, I think, in Canada, unlike the US, is we really don't have a definitive number of cattle on feed. The US puts out significant effort from a logistical, statistical point of view to measure cattle on feed, mind you, in large feedlots, but still significant effort. We have Stats Canada data on inventories that provide a pretty good base, but it's not quite the same here. And so when we deal with issues like BSE in 2003, when we deal with some of the challenges with the closure of Cargill or High River, Alberta, et cetera, we don't have as accurate information to truly understand some of the surpluses, et cetera, that could be out there. And so we end up having to estimate numbers. And it doesn't mean that estimates are wrong, but it's not as precise as having some of these exact type surveys as you might that could come out of, for example, things like the number of cattle sales, that kind of stuff. And so one of the complexities of the Ontario market, as many of you are aware also, is the number of Western cattle coming into Ontario feedlots that end up being slaughtered in Ontario. And if you look at the hog industry, we call that origin. So the main statistic that Ontario Pork, for example, uses is a term called Ontario origin hogs, which are produced here but end up in other markets across North America. We don't really have an equivalent in beef in Ontario or across Canada for some of those reasons. But since BSE, we've estimated that about 40% of the fed cattle on Ontario feedlots are from Western Canada. And my numbers in 2020 would suggest that's at about 38%. And again, varies by year, varies a little bit by area, by producer. And you can see certain areas of the province where there's large numbers of cattle on pasture over the course of the summer, over the last number of years. And a lot of those are Western cattle on transport routes, et cetera, to the West. I think that's become a pretty common thing. And to me, it reflects the reality of the sector. Since BSE, we've had, which would be 2005, we've had roughly an estimated 8% of the fed cattle that are in Ontario feedlots being sent to the US for slaughter. In 2020, that we estimate that at about 5%. And we've still got a little bit of data for December yet, but so down a little bit. So it hasn't been the outlet that we would have expected. And so the graph below, basically, the purple line is the total number of cattle slaughtered for Ontario in the province. And the line below is the number of cattle that I estimate over the course of the year on Ontario feedlot. And the gap between those lines is going to be filled by cull cows, primarily at federal plants. Yes, there's some cows that go through our provincial plants, but in general, that's going to be filled up with cows. And as you can see, the gap has kind of widened after 2009, and that reflects on some of the outlets available to us, and it's widened a little bit with the closure of Riding Regency, as you're well aware of last year. In terms of our total slaughter, so that's slaughter within the province, that was down about 5% in 2020, which we would expect because of, in particular with the closure of Cargill and some of the slowdown in a couple of provincial plants. Slaughter at federal plants was down about 9.5%. Average weekly slaughter at federal plants in 2019 was around 12.1, and in 2020 it was around 10.7, primarily because of that drop off. We're up to in the neighborhood of 12.5 right now from a federal point of view. We have roughly around 1,100 cattle a week coming from Quebec, and the vast majority of that are cull cows. Interestingly, if you look at 2020, our provincial plants, they were up about 25%, which is equivalent to about 25,000 head. And roughly half of this was steers, heifers, and cows, and the remainder veal cows. The thing about provincial plants in terms of aggregate numbers is that the bulk of that is a custom kill. It's a considerably different model where the producer's taking the animal in, as you're all very well aware, and then potentially selling that from a meat perspective, domestic use, whatever the case may be, rather than federal plants where basically the animal, you're transferring ownership, and the beef processor is, taking the value of that further. And so that's, I think, one of the significant things from a capacity point of view, and I'm going to come back to that in a bit. Pretty much across the board in the meat complex, whether it's in the chicken industry, whether it's in the pork or the cattle industry, carcass weights have been increasing. And that's due to the fact that, there's more demand. We want to try to be more efficient, and we're trying to get more out of the animal. And we can do that through higher carcass weights to a point. And the next presentation, I think after this, is going to discuss some of those key things. An animal can get too big depending on the market perspective, et cetera. What we've seen over the last number of years in Ontario and Canada is that number ratcheting up. The Canadian number tends to be lower on a carcass weight basis. Ontario fed cattle averaged about 880 pounds on the rail in 2020, which is up around 13% from 20 years ago. We're seeing some really heavy cattle go through right now to a large degree because of some of the slowdowns in the surplus. And I think that there's this sort of limit that's there. It is interesting to me, having been somebody heavily involved with the design of all of the BSc programs in 2003, and some of the challenges we thought about, talked about, and dealt with from a carcass weight point of view, and to see, quite honestly, some of those changes dissipate as time has went by, and people effectively being able to deal with it. So it is a reflection of the industry's ability to adjust, which I think is, again, one of the strengths of the industry. When your major feed component is also sold from a grain perspective, it creates a lot of challenges. We call that in economics opportunity cost. I can grow my feed and put it through as meat, or I can sell it domestically as a crop. And that's long been a challenge, not unique to Ontario, but certainly been one of the challenges of the livestock sector, North American wide and worldwide for all intents and purposes. But in Ontario, we have a number of unique circumstances, and that is that the demand for corn has grown significantly from a variety of levels. And a lot of people tend to relate this to the demand for ethanol, both here and in the United States. But a lot of it, I think, also has to do with the change in way corn is used in overall livestock. If we look at the dairy industry as an example, corn is a much higher portion of the diet in an industry that's basically completely went to contained feeding compared to, when I was younger, for example, or in years past where the animals were pastured to a much larger extent, got a higher portion of their diets from other forages. So that strong demand has resulted in effectively a record basis level over the last 2 years. And corn in Ontario is normally on an export basis. It means it's below Chicago when you adjust for exchange rates. And it means that basically, it's discounted against what the US price is. Calendar 2020 was really the first year that I've been involved in this industry where pretty much the entire year, almost every week, that basis was basically import, which means we're above Chicago. That effectively means you have a higher price for the product. And the reason is that there's significant demand, and that in turn has switched the industry in Ontario quite significantly in the grain and oilseed sector, but also in the feeding sector. And based on the data right now, this was the first time that Ontario was an overall net importer of corn in calendar 2020. And again, one of the things to remember about the grain industry is that even though we tend to talk about calendar years, and we talk about that when it comes to the livestock industries, the more accurate representation in grain is on a crop year. So the crop year for corn, for example, goes from the 1st of October through the end of the year. That's effectively when you have production. And so the cycle, this bar and this graph, you can see how things were up and down. That is a reflection of basically normally when the basically storage gets empty. The last point I'll make on this is that one of the things that's also had a big impact on the Ontario industry and from terms of corn basis is on-farm storage. From a historical point of view, this province, if you go back 20, 30, 40 years, we were a sell off the combine industry when it came to grains and oilseeds. There wasn't a lot of contracting, and there wasn't nearly as much on-farm individual farm storage. And that's changed over the years to a large degree because of contracting options and the size of our farms. And when that has happened, elevators and buyers of corn have to bid stronger to get that corn out of the industry, out of the individual farmers' hands, and that reflects to a large degree in some of the changes of other bases as well. So there's a multitude of factors here, all of which have a significant impact on our feeding industries. As was talked about earlier with feeder cattle, I think that local demand for feeder cattle in Ontario, especially good cattle, good stockers, etc., is extremely strong, has been for an extended period of time. And I think you could go back several years for this. And there's points in time, if you heard me do this presentation, where there's been years, 3-4 years ago, where effectively if I'm selling a stocker calf at 550 weight, I could be getting 2 years worth of income from that animal compared to say 10 years earlier. And that's had a big impact on people's decisions, I think. But one of the things that's changed from my perspective in the last couple of years in the basis and in how the market responds is that weaker cattle, it's a complicated thing what weaker means, because weaker can mean simply the day at an auction, because stocker cattle are really the only commodity in this country that continue to be sold primarily at auction. And auctions have a lot of, as many of you are very well aware, sort of idiosyncrasies with them. But that can occur in a number of areas. But weaker cattle, from my perspective, and continued over this past little couple of years now, and I think they're going to continue to be more heavily discounted. And that what tends to be is that they tend to be more in the bottom of the range on a sale day. And there tends to be things about them in terms of the product quality, as we saw in the poll questions earlier. And again, quality is a relative thing. Everybody has a bit of their own version of what quality means. If you're somebody that's doing grass-fed beef, for example, as a marketing tool, as an attribute, you may have a different perspective on what quality is versus somebody that's putting cattle into a feedlot for a heavy corn-based diet. And so that there is a difference there, but that also plays out into how you buy, the volume you buy, and where you buy. But I do think in general, the Ontario feeder calf basis will continue to be quite strong relative to Chicago, but that doesn't mean for individuals, there won't be significant pressure on it. And I think that is one of the unique things about the auction system in terms of the transactions that occur. Sorry. One of the things we've talked a lot about in the industry, and so I wanted to cover it off, is the spread between Ontario and Alberta. And from a fed cattle point of view. And again, there is some challenges even in that measurement, because in Western Canada, historically, the measurement on a fed cattle basis is on a live basis. In Ontario, we've had measurement of fed cattle prices really in two ways: in our auction system, which over time has really weakened in terms of the number of animals going through those auctions, and then a rail price, which is basically sort of self-subscribed to in terms of producer participation and providing that information. And so there is a little bit of nuance there, but I think one of the key things is that after we saw the closure of the Lebanon plant in Quebec and some of the changes in terms of Ontario production, we've switched from being basically on a positive spread to Alberta, where our prices in general were higher, to being negative. I don't necessarily see that as something that's a reflection of too much market power in Ontario or something that is really particularly negative per se. But I think what it is a reflection of is that there is far fewer outlets for Ontario producers to sell their cattle. And in turn, that has had an impact on the likelihood of those cattle being moved elsewhere. I don't think it necessarily means that we have a weak basis here per se, because I think that's often referred to. But I think in general, it means that, you know, we have to recognize that we don't have the number of outlets. And that is something I'm going to come back to at the end in terms of what I think is important from building the capacity of the sector. The fed cattle basis in Ontario, you know, historically starts the year pretty weak, which means below Chicago, and then tends to move up. This last year, that was the case, and then the remainder of 2020, the blue line here, both on a rail grade and a live grade, and I've done that to try to show those distinctions, has been extremely strong. And I think that, you know, there are references in a variety of outlets over the course of the summer around railgate prices in Ontario, around live prices in Ontario being, you know, some people refer to them as, you know, some of the strongest in North America. I'm not going to make that assertion necessarily, because I don't have all of the data to prove that. And again, you know, stocker animals and fed cattle are subject to a lot of different things, and, you know, comparing prices between regions is fraught with some issues if the animals and the market conditions are different. But I do think there's a few things to reflect on here. One is that the basis has stayed relatively strong, which is an advantage for producers. But the other being that, you know, it's pretty clear to me on this basis that the Ontario plants have a strong underlying demand for Ontario fed cattle. And I think, going back to John's point, it is a reflection of the fact that we have strong demand for meat, for lean protein here in the province. There is a growing interest from all different angles around locally produced production, which, again, local starts with Canada, goes down to the province, and then can go even further below that, depending on your perspective. But either way, the federal plants, and we've only really got two of them, as we're well aware, the basis is reflecting that they want these animals. And that's not to say it's not without issue, because there are issues. And for individuals and some of the challenges there are. But it is something I think that's important to build on and reflect on in terms of how we approach, you know, trying to improve and grow the sector. So when I talked about the US cutout values, I wanted to try to do a similar analysis for Ontario. And like I said, we don't really have the same measured cutout for this province like we do in the US, not at least from the mandatory measurement point of view, but we do have some data that Stats Canada produces on manufacturing beef. Now, this is at a national level. So that's the blue line in the middle. That's the manufacturing beef price. So that's measured as the price of beef that manufacturers across Canada are charging for the beef they sell into wholesale and retail markets. And again, this is an index. So what I'm really only interested in here is the variability. I'm not interested in the relative levels, because I wanted to see whether or not we saw the same kind of tracking as we did in the US, and see if that price tracked through to the retail level. And it appears it did. That isn't always going to be the case, right? And if you look at a lot of industries, right, the DFO increases the COP for milk. The price in retail milk doesn't necessarily always go up for a variety of other factors. And that is something, again, long-term to keep thinking about. And I think John pointed at a good point around, again, developing attributes where people can reduce their view that you're substitutable and see your product as something that you're willing to at least want or pay more for, or both. And I think that where we're going through with COVID right now increases the desire to get that Ontario product. Second to that is the other types of attributes that it could provide, either that it's, you know, maybe it's more fresh, or it's got a higher quality, or whatever the fact is. I think just the fact that it's Canadian right now because of COVID is something we can build on, an Ontario product to keep building that. So where's the outlook taking us? Where do I see the market going? Just in general, I think, you know, there's a number of factors at play. First and foremost, 2020 was a year where operating expenses at the farm level rose pretty significantly. We haven't really seen a year where, you know, prices and costs at the farm level overall risen as much as 2020. It's been a number of years. And we're suggesting right now it was about an 8% increase, which is pretty significant. The general farm input price index, the change in cost from one year to the next at a sectoral level, you know, in reality isn't a whole lot different than inflation over time, maybe a little bit steeper, but not a whole lot. But 2020, and you go back to 2008, you can see on this chart, have been years where those numbers have jumped up quite a bit. And that is to be expected, I think, given the circumstances. 2021, we're looking at about 1.5%, 1.3% right now. Time will tell how that plays out. A lot of it hinges on the impacts of COVID and how we've adjusted and where that goes. If some of the challenges that we've experienced will continue to persist, delays, that kind of thing, I think, you know, this number will be understated. It'll be a higher percentage. But I think that that's, you know, sort of first and foremost, one of the drivers that goes into understanding that. From a grain and oilseed point of view, from a key input point of view, you know, grain and oilseed prices are set to go up. Corn right now on a spot basis is $6.20, $6.30. Soybeans at some pretty high levels as well. Again, that's the crop that's already harvested. It's the crop that's in storage. New crop is about $1 less roughly, about $2 less roughly when you're dealing with soybeans. Anybody feeding animals right now, you know, is going to be in a situation where their costs, at least unless they've booked ahead or taken positions to offset some of that, you know, feeding costs are going up pretty significantly right now. Where it goes over the course of the fall is going to hinge a lot on US weather. If we have a US drought that continues, that fall price is going to run up to levels that are similar to the spot price now. If in fact the US gets a lot of moisture, if in fact we get a crop in as expected, and if the US planting progress and crop conditions are good early on, I think we'll see a fair bit of mitigation of that, and you'll have some cost mitigation as far as the corn side goes as we move into the fall. But again, corn prices, soybean prices are looking really strong for the next year and a half or so from a US point of view, and certainly from an Ontario point of view. And when you build that into the fact, as I mentioned earlier, that the Canadian and Ontario market is continued to be on an import basis for corn, all of those things lead into more expensive feed as far as the opportunity cost goes of feeding cattle. So looking at where we're going from a feeder point of view, as I mentioned earlier, you know, when you're looking at market prices and trying to understand them and figure out how you look at them from a forecast or a futures point of view, you know, there's really no end to information. In theory, you can take the futures market every day of the week and look forward to the next year, year and a half, and give yourselves a picture. But the futures market varies every single day. It varies on a variety of different things that happen that day or that are happening over the longer term. But there are certain points in time where it sets the sort of tone, I think, for a particular period. And as I mentioned, When the USDA puts out their November price report, crop report, what they call the WASDE, the World Agricultural Supply Demand Estimates, they do that roughly on the 10th of November every year. And that's the first time, as I mentioned, where they're doing real crop measured data, where they're knowing what their yields are, et cetera. From my experience, that is the date, or within a few days around that date, that to a large degree can give you a really accurate or reasonably accurate picture of the year to come. Now, it doesn't mean things aren't going to vary, but from my perspective, that's the dates that I use when I'm doing forecasts for the next year. And that tends to work to give you a pretty good flavor of where things going. And so that's based on November 20th. And so this information here, which gives basically an estimate of where I think the feeder prices in Ontario are going to move over the next year till we get to the end of 2021 calendar, are based on. So the red line is the nearby Chicago as of that date, happens to be November 11th for this year. And as you can see, relatively flat, not a whole lot of movement. And that's normally how the feeder market works. It tends to work in an uptrend or a downtrend, with a bit of a tick up as you're taking cattle onto pasture in the spring. That's usually right around that May point of view, and then a reasonably flat period. The blue line is the Ontario number, and that's a function of the weekly basis. The weekly basis, the other charts I showed previously, you can go to our ministry stat site. It has weekly calculations on basis, so you can go and look at where the basis calculation is for the Ontario price relative to that Chicago price for any week of the year, and look at it over time to give you some perspective on that, and that gives you a flavor for that. But again, I think there's relative stability with some key points of fluctuation, and recognizing that the variation around this is the key. The calf club sales that were referred to earlier are going to be on the high end of this, and they're going to be on the top end of the range. And the reason is because of the various qualities that they bring forward. And there's no doubt about that. That is the case. And it doesn't mean that on a particular point in time, some of those calf club sales might be challenged for a variety of different reasons in current market circumstances, but that's pretty much the case anymore. What I think is the riskier point is the variation below that. So if you're a smaller producer, somebody that's producing less consistent products, somebody that isn't producing quote unquote the quality animal, and it was pointed out in those earlier presentations more and more about what those things mean, and those things have meant the same for a long time. That's not a new concept. Animals dehorned, weaned properly, castrated properly, you name it, proper conditioning, that isn't a new concept, but it is a concept that isn't always applied by everybody in the same way for a variety of different reasons, some of which are completely valid. But either way, that's going to create the range around that. And I think that's one of the biggest challenges and risks that individuals within the sector have faced and are going to continue to face. Again, not new. I just think it's going to continue to be a bit more pronounced than it might have been in the past. On the fed cattle side, you have a lot more cycle. The cycle tends to move across the summer months where you have a bit of a peak and then flatten towards the fall when you have a surplus of animals, when those animals are coming through the market. And I think that's going to be the case. We've continued to have a strong basis in Ontario on the fed cattle side. I don't really see that changing. Most of my forecasts, this one and the previous slide, are based on historical, so they're based on a 5-year average. We've tended to be above that 5-year average, certainly on the fed cattle side. So I think that, even you could potentially see some movement above that. But again, it's going to function a number of key things. And I think that one of the tricky things about the industry in terms of price information as well is that the information that we get, certainly on fed cattle, it tends to be a very general number. It doesn't include discounts. It's kind of like the corn price. Corn price is for number 2 yellow corn. If I deliver corn and I get a dockage discount for moisture or whatever the case may be, that doesn't generally reflect in the numbers that we have access to. It reflects in aggregate numbers down the road from the grain farmers of Ontario, but it doesn't reflect in the elevator board prices you get from the farm market news or the stuff we might get weekly, or many of you participate in even daily over email. So again, the range around some of these prices is really the key, and those are the individual things I think that are going to be specific to individual producers, and some of the risks that are not new but are going to continue to be the case and likely continue to be more pronounced because of some of the things that COVID and other challenges have created. And so again, I think that what that comes back to is that you've got cyclical prices, strong basis, but probably a weakening of futures, and you've got basically potentially ratcheting up corn prices. And from a feeding point of view, this chart is one I've been showing for a number of years now. It's on the estimated feedlot returns per animal, and this is based on the cost of full pricing of feeding corn. So we call this opportunity cost. So it's not based on the cost of growing the corn, it's based on the cost of you are buying the corn. So it's higher in that regard from what a lot of people do, but it kind of goes to this idea of what am I converting, meat or grain? And we continue to be pressed in that regard. And that's not necessarily changing per se. I think there might be opportunities to balance that. If you're in a down market or in a clear up market, there are big opportunities to hedge that can reflect in that, that don't always exist depending on where the market's going. So that's one potential risk mitigation tool. But it's kind of the reality of the situation. And I think that this is not a new circumstance. I'm not necessarily pointing out something that's a big surprise to anybody in the feeding industry, but I think the pressure is going to continue to be there. So what do I think about expansion? And I think, John's perspective, I think it was really good to come before my presentation, because I think there's a number of things to take out of this. And anybody that knows me knows I'm pretty involved in the industry and somebody that has been trying to do a number of things from a marketing point of view for our stuff to try to differentiate. And I think that there's a number of things to remember. So when it comes to Canadian agriculture, the impact of farm incomes on markets is different for us than it is in the US. The US is a price setting country. They have this yield price offset, as I always describe it. Low prices will squeeze margins and farms respond by cutting costs. Production will eventually and production in many cases, and production eventually rises prices and incomes. And that's this whole idea of cycle. And the US has that because of this yield price offset. They set the market. We don't really have that to the same extent in Canada. And so when we have these type of issues, they get reflected in the basis and so on. And the cost efficiencies and the volume are really the only way that we can increase our farm income when prices are low. And so the likelihood of significant expansion here on the price side is really unlikely. And I think that plays into John's points, which I want to echo, around what is it that we can do to grow the sector. And I think it really comes into expanding capacity, and that comes on the feedlot side and on the packing side. And so it comes to the fact that we consume a very large amount of US beef. We consume a lot of other countries' beef as well, but US in particular. And there's a continuing opportunity, I think, to displace imports. And that's the case across the board in Canadian agriculture. You can go down the list of commodities where we have an opportunity to displace imports and pick up production and add value. And there are certain times in history where that is of greater interest than others. BSE, for example, created significant interest in the demand for Canadian beef. And it was a reflection of Canadians' interest in helping an industry that was hurting, and they were hurting because of the actions of another country, in that case, the United States, and the issues therein. COVID has created, I think, another opportunity in a variety of different ways. One, because people are eating more at home, but also because people, I think, are starting to understand the importance of supporting domestic production in a lot of things, not just in food, but in vaccines and all these other kinds of things where you start to say to yourself, so where is it that we want to be? Do we want to be in a position that we're relying on others or not? And I think beef is one of those areas. And that's going to require more feedlot production and hopefully feedlot production from Ontario calves. And I think that the demand is there to do that. I think that from a practical point of view, this is a circumstance where to do that, we are going to need to expand packer capacity. And I don't necessarily believe it's completely at the federal level. I think provincial packer capacity is a significant issue, which would grow and help provide an opportunity for beef farmers in general to provide attributes, to take a larger portion of the value chain and hopefully build the herd and the capacity of the sector over time. And I think that could flow through to the federal side of things, as well as flow through to the major feedlot side of things. But I think it's a whole industry approach that needs to be done in that regard. And so again, we've followed the US herd. We've seen unprecedented high prices at points in time over the last 5 years. The US and Canada is in a slight contraction. We do need a number of things. We need federal packer competition. And that can be achieved in a number of ways. We do, as I've mentioned, have room to take on more cattle, but I do think it needs to be demand pulled through as opposed to supply pushed. And I think it starts with growing our packer capacity at the provincial plant level and hopefully in time at the federal level. I fully echo John's points about opportunity in the sector, and there's all kinds of them. But again, it comes down to individuals in many respects, and you as an individual business, as an individual farm, and the opportunities that exist there. For some people, commodity agriculture is the level of attribution they want, and that's fine. For others, it isn't. But generally speaking, those attributes come with other costs and risks, and there are things that have to be addressed accordingly. So anyways, thanks very much for the opportunity to present. I really appreciate it. Hopefully there's a few questions, and you guys know where to get a hold of me if you need to reach out. I'm happy to answer any questions outside of this as well.
Thanks, Steve, for your great presentation and market outlook. We do have one question right now in the Q&A, and I think we'll keep it at that just to keep on schedule here. So the question in the Q&A, Steve, is before 2003, was the percentage of Ontario fed cattle sent to US, or what was the percentage of Ontario fed cattle sent to US for slaughter?
I'm just going to go back a couple slides. Apologize for your eyes. It was really quite small. So if you go past 2003, well, I guess it would have been a little bit lower than right now. So we're talking probably about 10%, I would say. I don't have the percentage off the top of my head, but it's actually been relatively flat, except for a few years like 08, for example, when Levenoff closed. That was the big year that we saw a big jump in the numbers. Now remember, this is fed cattle. You also have cows and a number of things that would be this. I've been trying to focus here on fed cattle.
Okay, thanks, Steve. Again, appreciate your talk today.